Australia's top 500 companies look to be shunning equity and returning to debt. Research obtained by Lateline Business suggests most plan to raise additional capital this year through debt facilities rather than new shares. Moody's fired a warning shot across the big banks' bows for their over-reliance on the wholesale funding markets. But if corporates are looking to grow, banks may find themselves raising yet more from offshore. Here's Emily Stewart.
During the global financial crisis, corporations lent towards equity raising rather than debt. But now it looks like the wheel's turning full circle.
The last 2 or 3 years, these large institutions have pretty much cleaned up their balance sheet. They've improved their equity ratios through placements and calls on shareholders.
Eastern Partners and Insto have surveyed 449 of the top 500 Australian companies for their report into debt capital markets. The report found most companies are looking to raise new debt to fund merger and acquisitions rather than refinance existing facilities.
Currently, outstanding balances in this institutional lending market based on bilateral bank lending inside Australia is about $162 billion. We're forecasting that to go to about $450 billion in the next 6 months.
In the past few years, more and more Australian companies have been going directly overseas to borrow cash. Last year, the US private bond market grew by 62% to $45 billion, with Australian companies accounting for 10% of those bonds. But Paul Dowling says there's now a return to using large domestic commercial banks with less of a cost difference between local and offshore funding. He says 49% of companies are currently using the big four banks as their primary debt capital providers, and 37% use investment banks.
Demand for borrowing in other sectors of the economy remains very subdued, and this is about the only game in town.
But the move towards debt comes at a time when banks are deemed to be over-reliant on the overseas money markets. As Lateline Business reported last night, Moody's has downgraded the big four banks' credit ratings for the first time in 15 years.
There is a fundamental structure in the financial system in Australia that means that savings generated in Australia are not easily available to the banks. And that forces the banks to go into wholesale markets to look for funding.
For now, the banks have plenty of cash to lend.
The problem they're finding is placing those funds. Demand is very flat in the SME and middle markets. It's certainly flat in the residential mortgage lending markets.
That sensitivity to wholesale markets, we think, is reducing at the moment, but the second that you get renewed credit growth, we think it's highly likely the banks are once again going to have to fund in markets.
In other words, the banks could find themselves under pressure once the economy picks up ahead of steam.